So over the last 12 months, my portfolio is up over 33%. Last year in 2023, my portfolios were up way above 40%. And over the last 5 years, it's up over 190%, way above the S&P 500. But let me tell you a secret. Over the last 1 year, 2 years, 3 years, 5 years, I've had many losing stock picks. But here's how I dealt with them. So I'm here to tell you that no matter how great you are as an investor, there'll be many times when you buy a stock and the price goes below your purchase price, oftentimes way below your purchase price. And this happens to everyone. So if you experience that, there's nothing wrong with you. I mean, think about it. Warren Buffett is the greatest investor in the world. He's been at this game for 80 years. And he still does it. Like in the last 3 years, he's been accumulating Occidental Petroleum, ticker symbol OXY, and it's now one of his biggest stocks in his portfolio, and after 3 years it's still below his purchase price, which is about $58. It's now $51. So what's the reason? Because remember that in the short term, stock prices are driven by emotions, by news, and by manipulation. They don't always reflect the actual value of the business. And as an investor, there's no way you can predict or control where the price goes in the short term. Now, the problem with most people is when they buy a stock and the price goes down in the short term, they are quick to label it, oh, it's a bad stock, it's a losing investment. Don't be so fast to judge yourself, because I can tell you that by and large, if you buy great companies using certain criteria which I've taught you in the past, and when the price goes down initially, oftentimes it's not a bad investment. It's not a losing investment. It is actually a winning investment. It just hasn't had time to realize its potential. So in this video, I'm going to show you how to tell a bad investment from a good one that has not realized its full potential. No matter how great you are as an investor, there'll be many times when you buy a stock and the price drops below your purchase price, sometimes way below your purchase price. I mean, think about it. Warren Buffett is the greatest investor in the world. And he's been doing this, playing this game for 80 years, and he still buys stocks that go below his purchase price. In the last 3 years, he's been accumulating Occidental Petroleum, ticker symbol OXY, and it's now one of his largest holdings. His average cost price is about $58, and right now, after 3 years, the share price is at $51. Now, the problem with most people is that when they buy a stock and it goes down, they're quick to label it, oh, it's a bad investment, it's a losing stock. Don't be so quick to judge yourself. Remember that in the short term, the market price doesn't always reflect the actual value and success of the business. Because in the short term, market prices are driven by news, emotions, and manipulation. And as an investor, there's no way you can predict or to control where the price goes in the short term. Now, indeed, some of your stock investments may turn out to be actually lousy businesses or businesses that become lousy. I've had my fair share as well. But if you invest in businesses that meet the right investment criteria, which I've talked about in the past, the great majority of them, even though the share price may go down in the short term, over time they will turn out to be great winning investments. But the trick is, how do you tell? How do you know if it's turned bad and you should get rid of it, or it's actually a good investment and you should hold on? So I'm going to cover that in this video. Now, before I do, I think it's very important to make it very clear the difference between trading and investing, because some of you may get confused. So again, there are some times when you or me, we may enter a stock as a short-term speculative trade. So if you enter as a trade, you're buying the stock based on the short-term price action. It's like it's uptrend, let's just go buy. But it's not because of the fundamentals of the business. And in those cases, if it's a short-term trade, then before you enter the trade, you got to have a predefined stop loss, usually at about 1.5 ATR below the purchase price, which is what I teach in my videos, right? And once the price hits the stop loss, you just get out. Get out. That's for trading. But again, remember that investing is different. I invest only in the fundamentally best businesses in the world, which I've talked about many times. Companies with strong economic moats, companies with low debt, companies with high return on capital, companies that have a history of consistency and predictability. So these are businesses, when I buy them, I have got a high level of certainty that they will go up higher in the long run. that they'll make more and more money over time and their intrinsic value will keep going up. And I buy them when they're undervalued. So for these companies, if the share price drops below my purchase price, I don't worry at all. Why? Because I know that the drop is mostly temporary. And in fact, I use it as an opportunity to add more shares until I've got a maximum position, because I know that in the long run it's going to go up. So short-term weakness is always a reason to buy. Now, having said that, again, there are times when some companies which I thought were great are not great. I made a mistake on my analysis, or it was great, but it turned to be a bad business. And in those times, I will sell. And I have cut loss on investments in the past. Companies like Disney, for example, I got out. Companies like Boeing, I got out. And like Boeing, I didn't actually cut loss. I actually sold for profit, but I sold it because I realized that it was a business that turned bad. So if the stock that you've bought, the share price keeps dropping down, should you hold on? Should you buy more? Or should you just sell? So it all depends on why the price is dropping. So there are altogether 11 main reasons why a price of a stock drops. So the first few reasons are what we call non-company specific reasons. In other words, the share price of the company dropped. It has got nothing to do with the company. Company is fine. It dropped because of some other reasons outside of the company. So for example, macroeconomic and geopolitical reasons, wars, recessions, interest rate changes by the Fed, bear market, every damn thing drops down, correction, every damn thing drops down. Okay, not every damn thing, almost everything drops down. Sector rotation, where money flows out of the technology sector, then technology stocks all drop like in 2022, and then it flows into the healthcare sector, all healthcare stocks go up. That's what we call sector rotation. Money flows between sectors and prices go up and down. Next, specific industry news that impacts the entire industry. For example, the Ozempic drug that was very popular caused medical stocks and food stocks to drop. And manipulation by market makers and high-frequency algo robots. So when the stock price of my investment drops, for the first 5 reasons, I buy more. Very simple. Because it's got nothing to do with the company, right? Any price weakness is a chance to buy more of a great company at a discount. So that's why I put it in green. These are reasons I buy, okay? Now, sometimes the stock price drops because of a company-specific reason, something that happened to the company, right? So number 1, company misses its earnings estimates or lowers its forward guidance. And this is very, very common. For example, I own Adobe, and recently they announced good earnings, but they lowered their revenue guidance and the price fell 9%. So for these situations, if I don't yet have a full position, I will just buy more, because again, this is very common. Great companies go through good and bad quarters, right? If there's a cyclical slowdown in demand for products and services, I'll buy more as well. For example, if you look at the semiconductor industry or the advertising industry, digital advertising, in the long run, it will go up because it's in a secular growth trend. But it doesn't go up in a straight line. It doesn't go up every week, every month, every year, right? Semiconductor sales, advertising sales, they go through what we call cyclical ups and downs. So when it goes through a cyclical down, and the share price goes down because of that, I'll buy more shares. For example, when Facebook, Meta went down in 2022, Google went down 2022, it was a short-term cyclical slowdown in ad sales. And I bought more because I know that long run, ad sales will keep going up as more people advertise online. So that's a reason to buy as well. Next, temporary bad news. Good companies get hit by bad news all the time, like product recall or lawsuits. And it depends on the type of lawsuit. Most lawsuits, like for example, the DOJ is suing Google to break up Google because of monopolistic reasons, I buy, right? Because I know that in the end, they can't do anything to Google. They can't do anything to Microsoft, right? US government is all bark but no bite when it comes to regulating companies, right? Sex scandal, no worries. I'll still buy the stock. The only time I won't buy a stock is if there's an accusation of financial fraud. That's the time that you got to get out immediately, all right? Don't touch that stock. Major shareholder forced stock liquidation, manipulation by market makers and algos, that's also a reason I buy the stock, right? So all the ones you see in green, I would keep buying the stock as long as, again, I've got not yet a full allocation. Once I've got a full allocation, I don't add more shares. That's the discipline. However, reason number 10 is a bit different. If sometimes the management of the business makes a very bad mistake, an execution mistake that causes a significant decline in profitability, then this I would not add first. I would hold the stock and let's see if the management can correct their mistake, then I'll add later on. So number 10 is a hold for me. Not a sell yet, a hold, okay? And I'll give you specific examples in a while with Nike and with Estee Lauder coming up. Just hold on, right? Now, reason number 11, this is the reason where I would definitely want to sell a stock. When the business itself has a structural problem, which is a long-term problem that permanently affects its ability to grow its profits and sales and market share in the long run. So when the company's economic mode deteriorates, when there's a permanent disruption to the business model because of competition, because of change in consumer behavior, because of technology, because of the government, whatever reasons is there, number 11, you gotta get out, you gotta sell. So with these principles, let me share with you how I manage my losing investments. Now, many people have said to me, Adam, you keep showing your winning investments. Why don't you show your losing investments? Actually, I do once in a while, but here they are. Ready? So currently, these are the stocks I'm still holding that are below my purchase price. And some of them are way below my purchase price. For example, number 1, Alibaba. I've been holding that now for over 3.5 years. And then we've got Estee Lauder. We've got 2 China ETFs, GXC, ASHR. I've got Celsius, which I just bought recently, but it's about 20% below my purchase price. We've got JD.com, which is a very small allocation. It's less than 0.18% of my portfolio. We've got Lululemon, which I purchased pretty recently as well. Hershey's, we've got Boston Beer, Evolution AB, Louis Vuitton, and Nike. So let me just run through these so-called losing stocks and let me go through with you my thought process of which are the ones that I'm looking to sell, which are the ones that I'm holding, and let's see how, and the third one, which is I'm continuing to buy, right, as long as I don't have a full position. So if you take a look at these stocks over here, you notice that, first of all, a couple of them are down for obvious reasons because of China. They're either Chinese stocks or they've got exposure to China that's dragged down their revenues and profits recently. So let's look at the China ones first. So China ones would be obviously Alibaba. We have got the 2 Chinese ETFs, GXC and ASHR, and the very small position in JD.com. So for these stocks, are they a hold, are they a buy, or are they a sell? They are all a sell to me. I've mentioned in my previous videos that I am done with China because I think that in the long run, they are not going to make very good investments. That I think my money can be better invested with higher returns in other markets like the US markets for various reasons. Many of them are structural reasons that have come about because of the new political regime, if you will. All right. And I said that, buying a Chinese stock is like dating a hot Chinese girl. And anytime the crazy father can come into the room and chop your dick off, right? So no thank you, okay? So to me, they are all a sell. Now, once I decide that a stock or a business is a sell, the next question is, do I sell it right away? Or do I wait for a better price to sell it, okay? So in certain instances where I feel that the stock has a lot more downside, that the business is deteriorating, is losing money, I want to get out immediately, all right? But if I feel that the business is not losing money, the business is making money, all right, and it's kind of like bottomed out, I would wait to sell at a better price. So in the case of Alibaba and JD.com, I would say that, when I first bought them before the government crackdown, they were great businesses, no doubt. They passed all my criteria. But once the government intervened and changed a lot of the regulations, Alibaba and JD.com, they are not bad businesses. They're not bad. They are making money. They are growing. It's just that they're not great anymore. They are just okay businesses. And to me, once it's not great, I don't want to be in it. I want to get out. But because the businesses are not losing money, they're not deteriorating further. They're just making money more slowly. And the price is very undervalued. I would wait to sell at a higher price. For example, if you take a look at the revenue of Alibaba, you can see that it dropped because of the government crackdown, but it has since begun growing again. And if you look at the profits, profits had a big drop after the tech crackdown and because of COVID and so on and so forth. But the profits have more or less stabilized. In fact, you can see that the last 3 years, profits have started to grow again. It's just that it's growing slower. Not a great business, but still an okay business. Not a bad business. And if you look at a balance sheet, it's very, very strong. They've got a lot of cash and very little debt. So there's no point selling now when it's so undervalued. If I don't need the money, I just hold it and sell it at a better price. So you may say, so what's the better price? So if you take a look at, for example, Baba, the charts. Now I own the Hong Kong shares, but they more or less track the US shares at the same time, right? So I'm just going to use the charts of the US stock, which is Baba. And my latest intrinsic value is about $136. And currently it's selling at $88, which is very, very undervalued. And I would probably want to sell Alibaba only if it gets nearer the fair value, which is about $136, which implies there's still quite a bit of upside from where we are today. Now, the same thing applies to JD.com. It's an okay business. It's still growing, just growing slower. So I'll get out at when it's nearer the fair value. So again, here's a chart to show you, if you have not seen it before, on why in the long run, I think that it's not worthwhile to stay invested in the China markets. And if you take a look, for example, at the last 15 years, you can see that certain markets, and not just China, but China, or even, in fact, even Singapore or Malaysia, for example, the GDP could be very high, this GDP, but high GDP growth does not translate to stock market returns. China has got huge GDP growth, but the stock market has had negative returns. Singapore, same thing. Singapore, very good GDP growth, but it doesn't translate into high stock market returns. Whereas in the US markets and even in India, you can see that with the GDP growth over there, US stocks way out-delivered the GDP. And a lot of this has got to do with whether the companies are incentivized to reward shareholders. So you find in the US, many of the corporate leaders, the CEOs, they own lots of shares of the company. So they're incentivized to act in the best interest of shareholders. And that's why share prices keep going up as the company makes money. But in certain markets like China, it's not the case, and so the companies could make money, the economy could grow, but as a shareholder, you don't see much return. So no thank you, I'm not interested to stay in those markets. Now, for my two China ETFs, one of them is GXC that tracks the Hong Kong market, the Hang Seng Index, and one is ASHR that tracks the mainland China market, which is the CSI 300 index. And again, long run, I want to sell them both, but short term, I think that they can rebound a lot because they are very, very undervalued. And I want to sell them only at a higher price, near the fair value. So roughly what's the fair value? Well, if you take a look at, for example, the Hang Seng Index, you can see that the median PE ratio is about 10 times earnings. And it's currently selling at 7.8 times earnings. So it's one standard deviation below the long-term valuation of the market. So once the Hong Kong market starts to go back near the fair median, about 10 times earnings, or slightly above, I will get out of my China ETFs. The GXC, for example. If you look at the GXC itself, the ETF, you can see it's, again, very, very cheap, because the current PE ratio is 9 times earnings. The projected growth of the company's earnings is 12.67%. If you take the PE ratio divided by the growth rate, you get a PEG ratio less than 1. So no doubt Chinese stocks are very cheap, but I'm not adding more. I want to sell them once they get to a fairer price, once sentiment changes, and it will take some time. When exactly it's going to take, how long, I don't know, but that's the key to investment. You just gotta be patient and just wait, right? Unless I really need the money for something else, then sure, I'll sell it right now and reinvest it. But if I don't need the money and it's a small position, like it is my portfolio, I just leave it there. The same thing with the ASHR ETF, which tracks the mainland China market, which is the CSI 300 index. And you can see that the median PE ratio is 12.5 times earnings for the last 10 years. And the current PE ratio is 10 times earnings. So again, it's more than one standard deviation below the 10-year valuation. Again, very cheap. I'm not buying more. I'm just holding it small position. Once it gets nearer 12 times earnings, 13 times earnings, I'm selling out of my whole position. So now that we have taken a look at the China stocks, let's look at the US stocks. So the first problem child in the US list would be Estee Lauder, and it's down 60% since I bought it, and I'm still holding on to it. So why did the share price go down? Well, it's a combination of various reasons. It's kind of like the perfect storm that brought the stock down. So first is a macroeconomic reason, which is COVID. They were badly affected by COVID, and management did not execute well during COVID, and they had a lot of supply chain problems. So it was a result of management's mistake that caused a significant decline in profits. At the same time, there's also an industry-wide slowdown for beauty products. So if you take a look at their competition, like Shiseido, it's down a lot as well. Ulta Beauty, down a lot as well. Elf Beauty, down a lot as well. But Estee Lauder is down even more than their competition because, again, they've got these management problems that they are working through. Now, do I think that Estee Lauder is going through a structural long-term problem where their economic moat has deteriorated very badly? They've got a permanent disruption in their business model, and there's a permanent change in consumer behavior? I don't think so. If I did, I would put this as a sell. So to me, I think that many of their problems are short-term in nature, and they are fixable. But it takes time to fix these problems. As a result, for Estee Lauder, I'm not selling it, but I'm not adding either. I'm holding it until I see a material re-acceleration in their revenue and their profits to prove to me that management is back on track. Then I'll add more. But for now, I'm just holding it. If you take a look at their financials, you can see there has been a big drop in their revenue for the last 2 years, and profits have really collapsed for 2 consecutive years. And they're the results of 2 main things. So understand that a big part of Estee Lauder's business used to come from Asia travel retail and the China market. When people travel in Asia, Korea, Hainan, China, they bought all these products. And so the pandemic totally disrupted this entire Asia travel market. So that's number one. Number two, management, they handled their supply chain very, very poorly, where they over-ordered expecting a rebound in global travel. It didn't happen. As a result, they lost a lot of money and a lot of inventory was sitting on the shelves. As a result, their operating profit margin from a norm of 15% dropped to 7%, and that's why their profits dropped significantly. So recently, management has been undertaking a profit recovery plan. So they're doing 3 things. Number one, they're optimizing their supply chain to bring back their operating margin from 7% back to 15%, and now it's gone up to 10%, so there is some improvement from there. Number 2, they are beginning to move into other high margin markets besides China. So they're going big into India, into Mexico, as well as into Brazil. Their China market share has also started to increase in the La Mer product specifically and the Renew Thrift product. At the same time, they're also focusing on more digital channels where they're now selling direct to consumer versus just the brick and mortar stores. So I believe that if they can execute all this properly, they should see quite a nice rebound of about 23% CAGR in their earnings over the next 5 years. So that should see the share price rebounding. Not immediately. I'll give it another 1 to 2 years for a proper recovery in the share price. Latest intrinsic value, taking into account their current free cash flow and their projected growth, is about $150. So at today's share price of $85, it's at a 50% discount. But like I said, even with that, I'm not adding more shares. I'm holding the position until I see an actual rebound in revenue and profits to decide whether to add more. In the meantime, keeping my position small. So because Estee Lauder is a hold, I would use a brown arrow, right? Whereas the reds are all sell. Now next, Celsius. Celsius is down about 20% for my purchase price, and I think that Celsius, by the way, Celsius is a speculative growth stock. And I think there's huge upside potential as they expand outside of the US market. And to me, the recent decline in the share price is more of a cyclical slowdown. not just for Celsius, but the entire energy drink category. So it's a more of an industry slowdown, cyclical slowdown, and to me that's a short-term reason. So to me that is a buy. So I'm going to put that as a green. Next would be Lululemon. Now Lululemon, I would say again, the main thing would be cyclical slowdown and recent earnings and revenue guidance softer than expected. Now there was some management screw up where the recent product launches were not done really well. They had this recent leggings which made ladies' ass look too fat, so people didn't like that, and there was some lack of colors. But I think that it was a very small problem because their revenues are still growing, their profits are still growing, it's just that it's growing slower, but their international revenue is still growing double digits. In fact, their China revenue is growing 34% year on year for Lululemon. And as long as my wife and my 2 kids go to Lululemon 3 times a week to buy stuff, which they are, I remain bullish on Lululemon. I think it's a short-term issue, right? So Lululemon is a green buy to me as well. And I've been buying Lululemon, by the way. I've been adding on. Now Hershey's, if you look at Hershey's, my Hershey's is down, I think, about 10% for my purchase price. But if you look at the revenue and the profits, there's nothing wrong with Hershey's. In fact, if you take a look at, let's look at Hershey's over there. Where's my Hershey's? My Hershey's is there. Okay, right. So you can see that Hershey's revenue is still growing, right? You know, profits are still growing. So what's the problem? Why is the share price down? Well, not a lot, but it's down 10% from the time I bought it, was because of input costs. So, and it's not just Hershey's, it's also affecting the other food packaging competitors like Mondelez, like Kraft Heinz, like General Mills. And for Hershey specifically, is a result of the sudden increase, a huge increase in cocoa prices, right? So cocoa prices go up, the Hershey's, their cost goes up, their margins go down, and that's what caused the share price to go down. Now in the long run, I believe that, again, cocoa prices will come back down. They have been coming back down. Their margins will stabilize, and Hershey's has pricing power. So once they start to raise their prices, they should have a nice rebound in their re-acceleration in their revenue and profits. So to me, Hershey's is a buy as well. Although I already have bought enough, so I'm not buying more because I've already got a full position. But if I didn't have any, I would buy. All right. For me personally, it's not a recommendation for you to buy. This is my own personal analysis. Okay. I'm going to skip Boston Beer. I'm going to go to Evolution. Now, Evolution is a stock where, to me, there's nothing wrong with the business. The business is doing very well. It's a fantastic business, but they just, their recent earnings was slightly, their revenue guidance was slightly lower than expected. And because of that, the share price fell, which I think is great. So I've been buying more Evolution AB. Evolution AB, by the way, they are in this online casino B2B business. It's a Swedish business, and to me, it's a solid business, in my opinion, right? So I've been buying more of that. Louis Vuitton, again, to me, this is a short-term cyclical issue. Their earnings were slightly below expectation. There's a slowdown for luxury goods because of high inflation, and again, to me, in the long run, will people spend on luxuries again? Will they grow again? Yeah. Okay. So to me, that's a buy as well. Next problem child, Nike. Nike is still down about 19% from my purchase price. So why is Nike down? Well, Nike's main problem is actually their own doing. So for Nike, it is because of their management screw up. Their management really screwed up over the last 3 years. But the good thing is that they have not seen a significant decline in profits. They are still making profits. Their profits are still growing. It's just growing slower than usual. So if you take a look at their financials, let's pull out their financials of Nike. Are we at Nike right now? Yes, we're at Nike right now. And you can see over here that their revenue actually has flattened in the last year. So it's not declining, it's just gone flat. And their profits actually dropped the year before, but in the last financial year, it has begun to have a bit of a rebound, right? So you can see there we are. This is the net income. So net income, it dropped over here, but it rebounded in the last year. Free cash flow has also been increasing in the last 3 years. So the financials are not that bad, okay? But the main reason Nike dropped again is because their growth has slowed down. And whose fault is it? This guy's fault. Nike CEO John Donahoe. How can you hire a hoe to do a good job? Anyway, so in 2020, he was appointed the CEO of Nike and he really fucked everything up, okay? So there are two things he did. Number one, at that time, as you guys know, you could buy Nike from Foot Locker, you could buy it from Target, you can buy it from Amazon, Walmart, you can buy Nike everywhere. But this smart guy, he said, you know what? We're going to cut away all the middlemen. So they do not let anyone else sell Nike. Only we can sell Nike through our Nike stores and through the Nike.com app. And initially it worked. People bought Nike online. But the problem was that once Nike was no longer selling on the retailer shelves, what happened? Competitors started to put their products there to replace Nike and to steal market share and mind share from Nike. So that was a huge mistake, number one. The second mistake was that in the past, Nike's organization was divided based on sports, right? So for example, you had the football team, you had the golf team, you had the running team, you had the swimming team, and each team had their specialists that would design the best shoes for running, the best shoes for basketball, the best shoes for soccer. And that's why that created a lot of innovation for Nike. They had the best innovative shoes. Now, this smart guy came in and totally changed that organization. He said, we're going to divide Nike now by gender. Okay, so men's department, and women and children. Okay, so, and they fired all these football experts, the basketball experts. They fired all these people. And they got people who specialize in making shoes for men, for women, and for children. And so because of that, they did not innovate as well because they lost all these specialists. And people started to go to their competitors to buy more innovative shoes that were better for basketball and running and soccer. And that is what caused the whole revenue to drop. So the good thing is that they just fired this guy, Mr. Ho, okay, and they replaced him with company veteran Elliot Hill, who my friends at Nike tell me that this guy will bring Nike back to their glory days, right? Where they will re-accelerate revenue and growth. But it's not going to be overnight. It's going to take at least the next 9 to 12 months for us to see some material re-acceleration in revenue and profits and a rebound in the share price. But again, as you guys know, for me, I want to see some results first. Okay, so I'm going to put Nike as a hold right now. Not a buy. It's a hold. I'm holding my position, and once Elliot Hill can show me that revenue is re-accelerating and I see a significant shift in the culture, I'll start to add more shares to Nike. So I'm going to give Nike again the brown hold arrow. Now, as a final mention, again, I'm running out of time, and so that's why I can't go into every single stock in as much detail as I want to, as I do with my community. But for Boston Beer, it's a hold as well. Boston Beer is a stock where, again, management really screwed up in the last 3 years, where they overprojected their hard seltzer sales. It didn't come into fruition, and they had a huge drop in their profits. But the good news is that the last 2 years, profits have been recovering, but not as fast as we would want, but it is recovering, and it is still very, very undervalued. So I'm holding for Boston Beer. So this is exactly how I analyze so-called the stocks in my portfolio that may still be below my purchase price. Again, some of them are sells, immediately sell. Some of them are sell at a better price. Some of them are hold, let's see, I may add more when I see better results. And some of them are, you know what? Short-term, temporary, I'm just going to buy more. So that's the important thing. And on a parting note, remember, even the greatest investors in the world, they pick stocks that still go down in the short term for 1 year, 2 years, 3 years, but they've got the patience to wait for it to recover, to wait for the stock to prove themselves. And even in the long run, not every stock you pick will be a winner. I've shown you this chart before. If you look at Warren Buffett, again, he's been in this game for like 80 years, right? And he's been running a Berkshire Hathaway for 58 years. And in his 58 years, he has owned and bought over 210 stocks or businesses, or maybe even more. And in his own admission, less than 12 stocks have contributed the majority of gains in his portfolio. In other words, only 5% of his stock picks have really made the majority of all the profits in his portfolio. And if you look at his recent portfolio results, you can see that Berkshire is doing very well, it's beating the S&P 500, but it's only a few stocks that are making it happen. Stocks like Apple and stocks like HPQ, like American Express is beating S&P. But many of the stocks he has picked, like CVX, Bank of America, Coca-Cola, Occidental Petroleum, NU, Kraft Heinz, Paramount, they are all below his purchase price and they're all underperforming the market. And it's the same thing for me. So I hope that through this video, you get better insights that yes, I've been beating the market consistently. I make millions in the market, but not all my stocks turn out the way I want in the short term. Some of them are underwater for quite a while, and some of them take time to really prove themselves. And that's why it's really important to always diversify into at least 8 to 10 stocks. Every 10 stocks you buy, and you follow my strict investment criteria, you can expect 2 to 3 of them to outperform exceptionally, to way outperform the S&P, to give you that 2x, 3x, 4x, 5x returns. These are your ASMLs, your Mercado Libres, your Nvidias, your Microsofts, right? But there'll be 4 to 6 stocks in your portfolio that will outperform, not 5 to 10x, but maybe 2x, right? Maybe, outperform the market slightly, right? Or to a bit of an extent, right? But you always have 2 to 3 that screw up in the short term, okay? So to me, it's my Alibaba, my Estee Lauder, my Nike. But again, the majority of them, over time, they will rebound. Most of them will. So I hope that you've enjoyed this video. It's a pretty long video, but I wanted to give you a lot of value for this particular video. So thank you for watching, and may the markets be with you, and I'll see you guys in the next one. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.